The 60-40 portfolio model has not been working out well so far in 2022, as stocks and bonds alike have been falling in tandem. So where should investors be positioned now in light of heightened volatility and rising inflation? Well, we're here to discuss these topics with Nancy Davis. She is the CIO and managing partner of Quadratic Capital, and she manages the Quadratic Interest Rate Volatility and Inflation Hedge ETF, IVOL for short. Welcome to the show, Nancy.
Thank you. Thanks for having me.
You have a very interesting product that we'll be talking about, how exactly your product works and how investors can be positioned and hedge against volatility. But first, let's talk about volatility itself and inflation. We've had plenty of both this year. Let's talk about, first and foremost, stock market volatility. The worst month on record for the NASDAQ was April since 2008. This has not been a good year for any risk assets, cryptos included, but we'll focus on stocks today. In your opinion, Nancy, what was the main cause of this sell-off?
Well, I think this is really a monetary phenomenon. We've had a lot of bond buying and stimulus, whether it's fiscal stimulus as a result of the pandemic or QE purchases. The Fed hasn't started yet to actually reduce their balance sheet. They're still, even though the taper ended on March 9th, so they've stopped actively adding new bonds, they're still buying new bonds as others roll off. And so I think this is a little bit of a wake-up call that, assets are volatile. Investing is risk. And, especially when you're buying corporate securities, whether it's their stock or their bonds, if that corporate has higher costs, maybe in the form of labor costs, more supply side disruptions in the form of, all the things that are happening around the world from a geopolitical and COVID perspective, coupled with consumer confidence in this country is at lows from 2008. So it really, nothing is shocking to us at all at Quadratic with the sell-off that's happened in 2022. It seems very, very much expected and very rational of markets.
What has puzzled some investors, Nancy, is why the markets have not priced in Fed rate hikes last year. Jerome Powell has not really been shy about the suggestion of raising interest rates faster than normal. In fact, he started tapering asset purchases, mortgage-backed security purchases around late last year. So one should assume that investors or the markets at large should be pricing in Fed rate hikes. But yet it seems that every time they hike something or they announce a 50 basis point rate hike or faster than usual rate hike, markets drop some more. Do you think investors at large were just unprepared?
Well, no, I think just a quick, it's May right now. And if we think back to a year ago, we were actually having very high realized inflation. You saw that picking up quite dramatically in the first quarter of 2021. But before the June Fed meeting, the Fed was, especially Jay Powell, he was actually telegraphing that they're not even thinking about raising rates. If you remember that was less than a year ago, and that inflation was transitory. Then that word got retired by the Fed, and then they pivoted to really surprise the market from, not even thinking about raising rates to having the dot plot in June showing actually hikes, multiple hikes. Now, I think it's important for investors to realize that the rate hikes from the Fed have already been priced in. The Fed's only hiked 75 basis points so far, but the interest rate markets have moved with the Fed's forward guidance. Mm-hmm. So it's we have about 6 months left in the year in 2022, and the rates market has priced in 175 basis points of additional hikes. So if the Fed does not hike 175 basis points, they're actually going to be easing rates. And I think that's really important for your listeners, your viewers to understand, is it's not what the Fed actually does, it's what's priced in. And right now, expectations are incredibly high because we have so many rate hikes priced in this year, plus even more in 23. And that's all just from the Fed's forward guidance.
175 basis points from here, not in total.
Yeah.
So
so in addition to the 75 that have already happened.
So that's 7 times 25 basis point hikes. Okay. So if that's what the markets are pricing in, well, do you agree with the markets? Is this too aggressive, or is this right in line with what you would expect?
Well, I do think, especially given how much equities and credit, corporate America is feeling a lot of pain. You can see that with, higher prices. That's hurting. Corporates are kind of getting hit on both sides because consumer confidence is falling and prices are going higher, whether it's labor costs or other input costs. So I do think the Fed hike expectations are warranted because we actually have very, very high inflation. I think the thing that's disconnected is that the market is saying because the Fed is going to hike, this is going to slow or cease inflation. And that to me is a huge disconnect where you have realized inflation at 40-year highs, but the expectations for future inflation are near 20-year lows in the rates market. So that disconnect, I think, is always a great opportunity for investors. You constantly want to be looking to buy, any market, whether it's equities, bonds, it's all about what's priced in and what's expected. And the rates market is saying right now, the Fed is going to hike and that's going to slow inflation. And that might not be right. The Fed hiking might just impact the demand side of the equation, not actually solve any of the supply side disruptions that we've been having, whether it's geopolitical or COVID related or the labor force being very tight.
I want to come back to inflation issues and your market outlook in just a minute, but just touching on the Fed and their outlook and their actually telegraphing of 175 basis points. Last year, as you have noted, they were talking about, they were saying that they're not talking about interest rate hikes. They were thinking about it. A lot of Fed talk. Now, this year, they've completely changed their tune. They've admitted somewhere down the line that inflation is indeed not transitory. Actually, President Biden has shared this view as well. He's made fighting inflation, a national priority. So, Nancy, do you think the Fed basically has any more credibility left is my question. If they're announcing that, for example, Jerome Powell 2 weeks ago announced that he will be okay raising interest rates above neutral, is that something that you as an investor take seriously? Is that something he was actually going to do, you think?
Well, I know the Fed has gotten a lot of critics saying they're not credible and all those things. I am not one of those persons. I think the Fed is doing the best job that they can with the tools that they have available. I think using the balance sheet is a very important monetary policy tool that hasn't started yet. I think that the plan is to start sometimes in June, but inflation is very much a money supply issue. And we've had a tremendous amount of money supply growth. And I think using the balance sheet more as a tool to help fight inflation is prudent and is something that, I don't know obviously what policymakers are going to do, but it seems like they're going to be using that in addition to hiking policy rates, because hiking policy rates just help squash the demand side of the equation. They don't actually control the money supply. So I'm not a critic of the Fed. I don't think the Fed is, stupid or making a policy mistake or lost credibility. But I do think, the market was pricing in inflation. Then the rate hikes got priced in, and now the market is not pricing in inflation to stick around. So I do think for investors, it's actually a really great opportunity to buy and add inflation protection in their portfolio because the market's very complacent that these rate hikes are actually going to stop inflation. So it's all about what's priced in the future, and future inflation expectations are not anywhere near realized inflation, which has been, the last CPI print was over 8.5%. PPI was above 11, but future inflation expectations are much farther below realized inflation.
Do you think the Fed's monetary policy this year, regardless of how many hikes they actually implement, will be enough, Nancy, to curtail inflation? You've mentioned supply chain problems that have been partly responsible for inflation. That's not within the realm of the Fed's control. So whether or not they hike rates by 175 basis points, perhaps even 200 basis points, whatever the number may be, is that enough?
Yeah, that's a big question that, we do have a lot of inflation right now. It's unclear whether just hiking policy rates is enough. I personally do not think it is because we already have these rate hikes priced in. Even before the Fed started actually hiking rates, it was priced in. It's just been priced in for more. And I don't think it's going to put more truck drivers on the road or cause a lot of the supply side issues And we still have, the Fed has almost $9 trillion balance sheet outstanding, and we haven't started to let the Fed is still buying bonds. Like even today, they're not buying new bonds, but they're not letting mortgages or treasuries roll off their balance sheet. They're still buying. And so I think that that's really important for your community, your client, your viewers to understand, is that we haven't had the liquidity injection. It hasn't stopped yet. So I think that's going to increase the volatility in bond portfolios and fixed income portfolios.
So how long do you think this 8% inflation can last?
Well, I don't think CPI is the only way to measure inflation. I think that's one key thing, is that it's just an index, right? So CPI is a consumer price index. It's nobody would buy the Dow Jones index or the S&P index or the NASDAQ index and say, ta-da, I have US equities and corporate America. Why would you ever use one index to calculate something as big and as broad as inflation? The big problem that I see with CPI alone is that a third of the index, approximately 33%, is what they call shelter, and it's actually owner-occupied rent. So rent tends to be very lagged. Year over year, rent and prices are up about 5.1%. Whereas home ownership prices are up closer to 20. So it's just not the only way to measure inflation. And that's what we try to solve with the iVol ETF, is we take a core treasury portfolio, but then we try to fix some of the issues with inflation protected securities on their own.
Okay. So then CPI is not the best indicator of inflation. What should we be looking at now, actually, Nancy, to give us a better gauge of inflation, and not just inflation, but inflation expectations? Keep in mind, inflation expectations is a forward guiding tool, whereas something like the CPI is a lagging tool. It comes out once a month and it reflects data from a month ago. So if I want to know where inflation is heading now, or if I want to know where the markets think inflation is heading, what are the tools or indicators I should be looking at?
So I think a very simple tool to look at inflation expectations is actually interest rates. So in every country in the world, the central bank sets policy rates, but where lenders lend money in the future is largely that term premium of interest rates. If I borrow money from a bank or from you today, and I say I'll pay you back next week, or I'll pay you back in 10 years, right? That should have that term premium rates, is where lenders lend money. And it's a very simple way, in my opinion, of capturing inflation expectations outside of CPI, because if you think inflation is going to be higher in 2 years, 3 years, 5 years, you would expect more yield over the policy rate to extend that loan.
Okay, well, you're certainly right. The nominal rates have been ticking up. Mortgage rates in the U.S., 30-year mortgage rates have been the highest in more than a decade. Let's talk about iVol now, the Quadratic Interest Rate Volatility and Inflation Hedge ETF. I'm glad you shortened that as an acronym, because that is quite a mouthful. iVol, iVol ETF, let's call it that. It includes TIPS, you told me offline, so the Treasury Inflation Protection Security, which tracks inflation. How does it work besides having TIPS in your portfolio?
So in addition to the, about 85% of the portfolio is that type of treasury bond, but then we try to fix the problems that exist with TIPS alone, which is, one, they're bonds, right? So all bonds, when interest rates move higher, they lose money in price terms. That's based on their duration exposure. So we try to give investors a way to actually profit from long dated yields going higher, instead of just losing money based on the duration exposure. Even and that's one of the problems when you own short duration strategies, you're not actually short, you're just less long. It's kind of a misnamed strategy. So we actually try to profit when long dated yields move higher, which would likely happen in a stagflationary or inflationary environment. So that's part of the strategy. Plus, we access another measure of inflation beyond CPI, which is future inflation expectations, measured by that term premium of interest rates that we were just talking about. And the other really attractive thing, in my opinion, for investors is we own options. And whenever you own options, you're long them, you're long volatility on the underlying asset class. So a lot of people think of volatility and they only think of equity volatility because that's a very common index. But anything that has an options market has a vol market because volatility goes into pricing options. So we actually own fixed income volatility, which is a nice potential diversifier.
What's the correlation between fixed income volatility and just generally inflation? Is it true that when we have an inflationary environment, volatility in fixed income products goes up?
Well, it's tough to measure because we haven't really had a period of runaway inflation or stagflation outside of this recent period since the 70s. Yeah. And a lot of these markets didn't exist in the 70s, these interest rate markets, the derivative markets, they weren't around. So a lot of people look to real assets or equities because that's the only thing that was available in the 70s was commodities and energy. But I personally think, energy and gold and all these, real assets might not be the best inflation asset because they don't pay any coupons. So there's no monthly distribution at all. Right. They do have carry costs, and oil and gold, there's no scarcity of these things, right? It's just a technology. It's easier and cheaper to get it out of the ground. So I think if you look at commodities and other equities that are sensitive to kind of inflation, and I use air quotes because they're not really inflation, they're just equities. Those things are at very, very high levels, like super, super high valuations. Whereas the rates market is not it's not the 70s way to capture inflation expectations, but I do think it's a very simple and elegant way to capture inflation expectations in the future. And that is trading near 20-year lows, even though realized inflation is at 40-year highs.
I'm just going to push back slightly on your statement about gold and oil not being scarce. I mean, you're right. Technology does help us extract resources more easily and most cost efficiently, but investors of oil and gold may argue that we invest in them precisely because there's a finite amount on Earth, and so over time they provide an inflation hedge. Whether or not the data actually supports that theory is a different question. But do you at least support the investment thesis that we should be investing in scarce resources to protect against your wealth?
So gold is not an inflation hedge, in my opinion. It's a currency trade. It has no yield. It has no carry. If we had interest rates move higher in an inflationary environment, because it doesn't have a coupon, you're actually penalized. I think, in my opinion, it's actually worse than cash. But I know there are a lot of gold bugs in the world. But I would question people and say, a lot of people own commodities already. Their prices are quite high. Warren Buffett is the one who said you make your money in an investment when you buy it. So you always want to buy things that are cheaply priced. And I just think a lot of people use commodities. I call that, this is a fake term, but I call it your grandmother's inflation because that's what worked, in the previous generation. But these markets that we're accessing now didn't exist then. So you can't back test it. You can't look. And so I think people are always looking at what worked the last time. And I just think oil is like, the laptop computer I'm speaking with you on today. It's a technology and it's very deflationary because it's easier to get it out of the ground. It's easier to transport it. It's not, and it's very expensive. So there is a scarcity, but especially with the movement to ESG, the movement to clean energy, you have to think, 20, 30 years from now, is that going to be a store of value, or is it something that is expensive right now because people are rushing to it because that's what worked in the last period of inflation?
I'm just going to throw something out there that I'm pretty sure your grandma or my grandma did not have in her time, which was Bitcoin. Some people argue that Bitcoin is an inflation hedge. I know what you're going to say, well, Bitcoin collapses here while inflation went up. Yes, that's true. But then Bitcoin maximalists would argue, well, Nancy, zoom out, look at the bigger picture. In its 13-year history, Bitcoin has outperformed pretty much all other assets. And so holding it long-term would provide some sort of hedge against inflation and or equity volatility. Is that a view that you share?
So I'm not a crypto expert. That's outside of my area of expertise. I don't really have an opinion on that. I know there are very diehard people who have extreme views either way, but for me, my expertise is fixed income, traditional asset classes, bonds, things like that. I do think crypto and Bitcoin in particular, to me, it's more of a currency view, similar to gold, a store of value, not necessarily inflationary. I think if you think the currency is a fiat currency, and whatever currency that is, whether it's a Turkish lira or the dollar or the yen, it might be a good diversifier potentially, but I'm not an expert in that industry at all.
Oh, that's okay. So speaking of traditional assets then, what about real estate? Is that something you've considered adding to your portfolio as an inflation hedge or not at all?
Well, I do think a lot of investors, I think most people own real estate or have exposure to real estate in their day-to-day lives. I've read some statistics that say 80% of global net worth is in real estate. So I think most people have that exposure. And I think the challenge to real estate is if we actually have inflation and the Fed does hike policy rates an additional 175 basis points this year, plus even more next year, mortgage rates will go up. So you kind of need inflation to keep up with wage growth, right? To be able to make those higher coupon payments, or real estate could actually depreciate in value, in my opinion. Because think about it, if you don't have inflation, it's less affordable. And most people do borrow money to access and leverage. They don't buy their home in cash. They typically use mortgages. So, we do have some investors that use our IVOL ETF as a potential real estate hedge. It has nothing to do with real estate. But if you do see interest rates move a lot higher, mortgage rates move a lot higher, you need inflation to be able to keep up with those higher coupon payments.
Yeah, that's right. I mean, you're right. Mortgage rates have already, the 30-year mortgage rate in the U.S. has already climbed to the highest level in more than 12 years. I'm just wondering whether or not this is going to have a significant impact on the real estate market in terms of housing prices, or whether or not you think that will weather the storm. What's your view?
Housing prices have definitely gone up, and there is a scarcity of housing, a scarcity of listings. I'm not a real estate expert, so it's hard. I think it's also very geographic, based on local markets. So it's hard to make predictions about real estate generally.
Yes.
But I think most people already own that, because we are real people. We do need real places to live. So I think most people have exposure to real estate regardless in their portfolio. And if you look at most real estate investors on the professional side, they tend to hedge their interest rate risk, right?
Yeah.
They hedge, that's part of their business model. But most regular people are not even thinking about interest rates, even though they already have that exposure. So I think that's where IVOL can potentially help to give them access to the rates market, because they already probably have that exposure, whether they're renters or homeowners or landlords, they probably already have real estate.
Okay, so I want to finish off on IVOL now. Going back to what I said earlier in the beginning of the interview, the 60-40 portfolio model didn't work so well this year. Stocks and bonds have both gone down. What is your outlook now going forward for the equity and the bond markets?
Well, I think
given everything we've discussed,
Yeah, I think bonds, you have to kind of break bonds into two different asset classes. There's bonds with spread risk, and then there's government bonds. Both have gone down this year, but I think especially for investors who have a lot of bonds in their portfolio, which tend to be retirees, inflation protection is even more important for that group of investors, because if we actually have inflation, if you have a lot of fixed income securities, because they're safe, the 10-year treasury has lost over 20% this year alone. We're not even halfway through the year. So bonds can be quite risky. All investing involves risk. And so I think adding a portion, of inflation into your liquid portfolio is important. And I think one thing investors really need to keep in mind is many of these passive indices don't have inflation protection inside of them. Like, for instance, the Lehman Ag, which then became the Barclays Ag, which is now called the Bloomberg Ag. It's an old index. It was created before the Treasury and even invented the inflation protected bond market in the late 90s. So there's no inflation protected securities in the ag. And if people own, core fixed income that's benchmarked to the ag, they probably have no inflation protection at all in their fixed income portfolio.
And how does IVOL perform in periods of high equity volatility? Let's assume that stocks continue to fall throughout the rest of the year as the Fed tightens. How would you expect IVOL to perform under these conditions?
So we don't own equity volatility. We own fixed income volatility. The fund has actually benefited from an increase in fixed income volatility this year, even though tips are down. So tips have lost money. Inflation expectations not measured by CPI is also down because
I'm wondering why tips are down considering that inflation's up. Can you explain that just very quickly?
Yeah, so the Fed has been more hawkish in their commentary. More hikes have been priced in this year because of the forward guidance. And the rates market is saying, okay, the Fed's going to be more hawkish, therefore there will be less future inflation expectations. So it's really a double-edged sword. You have to be very careful because the Fed has already moved. They've already tightened rates. So if they don't hike 175 basis points more this year, they'll actually be easing because that's already priced in. So it's a tough time because, the rate hikes are so much, they're already priced in to the market.
Okay. Well, Nancy, I appreciate your thoughts and your outlook. Thanks for coming on Kitco.
Thank you. Thanks for having me.
Thank you for watching Kitco News. I'm David Lin.